Set up a tax-free working capital account. In this episode, I'm going to address the question, where to invest profit from a business. A lot of times, business owners don't realize they can be making a ton of money on top of what their business is doing by having their working capital account be earning rates of return of 6, 8, 10%, totally tax-free. Get ready. I'm going to give you insights into opportunities that maybe you never knew existed before. So, I'm Doug Andrew. I've been a financial strategist for more than 4.5 decades, and many of my clients, over 1,000 of them, are entrepreneurs, business owners. In fact, I've licensed and trained and helped over 3,000 business owners optimize their business assets and increase their liquidity, safety, and rate of return on their working capital in their business. Sort of how to become their own banker so that they can be making money on their money while their business is making money. So get ready. I'm going to share with you how to do this because most businesses are in business to make a profit. Sometimes the first year or two, they don't make a profit. But when you do, you want to make sure that profit stays liquid. It stays safe and it earns a rate of return, because if you park that money in the bank, that is not passing the liquidity, safety, and rate of return test as well as you possibly could. And so I like to put my working capital for my business in what I call the laser fund. At the end of this episode, I'm going to show you how you can claim your free copy of my most recent best-selling book called The Laser Fund. So, LASER, L-A-S-E-R, is an acronym that I've used for years that stands for Liquid Assets Safely Earning Returns. It spells laser. When I run my business, I like to have money on hand, liquid and safe, where I can access it for opportunities that come along. Because sometimes businesses go through cycles. And so you have periods of time, like in my business, that summer, June, July, and August, we like to go play as a family. December, people are focused on the holidays. And so I have to sort of build up a cushion to get through those times. And when things are good, I want to take that profit and make sure it's on hand, liquid and safe for the leaner times. This happens during other types of setbacks like the pandemic, the coronavirus. And whenever we have a recession, a market crash, a pandemic, things that sort of throw us off base, so to speak, we want to make sure that money that we have earned, the profits, are there and available so we can keep the business running like a well-oiled machine. So, I'm going to share with you where I put my working capital because it's earning money, sometimes better than even my business is earning money. Liquidity, safety, predictable rates of return, and tax-free are the key elements, and those are the 4 pillars in my book called The Laser Fund. So get ready. I'm going to share with you what a working capital account is, why you should have one, and how you can become your own banker in your business to fund all of your projects, run your business by having the money, earning money, and how you wisely then access that money and keep earning 100, 200, even 300% more than the cost of the funds. Perhaps you've heard about the banking concept where you can have your own bank. I call it the laser bank because I think your money should always be liquid so that you can get it when you need it, okay? With an electronic funds transfer or phone call. That it's safe. You do not have it in a place where you could lose 20 or 30 or 40% because of a market downturn. No, you don't want to lose the money that you've made in previous years. You want to earn a predictable rate of return, and I prefer tax-free. So that's why I prefer my favorite vehicle. I call it the Laser Fund because it passes those LSRR tests with flying colors, and it's tax-free to boot. So when we talk about the Laser Bank, it is a max-funded indexed insurance contract. Now, what is that? This is actually the brainchild of E.F. Hutton, clear back in 1980, when they realized one of the safest places to have money grow is in an insurance contract. But instead of trying to get a certain amount of insurance, let's say life insurance, for the least premium, in case you die, you're doing the opposite. You're going to use it as a working capital account. And so you're taking the least amount of insurance the IRS will let you get away with, and you're putting in the most money the IRS allows you as fast as they allow. These are tax citations that were passed back in the 1980s. Why do you do that? Because back in 1980, E.F. Hutton realized that most insurance companies were earning between 11 and 15%. It was a high interest environment. I could earn 11 and net 10. What's the 1% difference? It's not tax, because these are tax-free. That 1% is the cost of the insurance that the IRS requires has to be there in order for it to qualify as a tax-free insurance contract. And so for many years, I earned 11 and netted 10. I earned as high as 15, netting 14. But ever since 1980, my working capital account for my business has been max funded insurance contracts. I have several. And so I'm able to earn rates of return of 11 netting 10. Some years I earn 8 netting 7. Some years I've earned 16 netting 15 or 25 netting 24. Let's just be conservative here and say that you're earning 8 or 10, which I've done for 45 years. So let's say I have profits. I don't care if it's 50,000, 100,000, a million. And I have this sitting over here in my portfolio of laser funds. Now it's earning tax-free returns, averaging 8, 10%. Some years, maybe I only make 2% or 6%, but the average has been 8.2% for the last 45 years. So on $1 million, that is earning 80,000 tax-free. Now, anytime I want, I can go access that money. I could access up to 94% of it without closing the account. I've never needed to access more than that. So it's extremely liquid. I can access the money with one sheet of paper that I can fax or email to the insurance company. Now, on this one sheet of paper, they're going to ask me 2 questions. Once I put my name and my account number, which is the policy number, they're simply going to say, do you want to withdraw 100 grand or a million, whatever, but in the amount that you want? Do you want to withdraw $1 million or do you want to borrow $1 million? Guess which one I check? Borrow. Why? Because if I withdraw the $1 million, it's no longer there earning interest. You say, well, if you borrow, they're going to charge you. Yeah, but with the insurance company, they can charge me 2% and they'll keep crediting me 2%, so it doesn't cost me anything. It's called a zero-wash loan. Or I have the choice of borrowing at like 4 or 5%. Let's say 5. So I borrow $1 million out of my policy at 5%. Why would I do that? Because they will keep crediting me what they're earning. 8, 10. There have been many years I've borrowed at 5 and kept earning 10 on the money I left there as collateral for the loan. So that means I'm making 100% more than the cost of the loan. On $1 million, they charge $50,000 and deduct it out of the $100,000 that I earned that year on my money, netting me 5% on my money while I'm still using it for my business. That's called a working capital account. But there are years like 2017 where we had clients borrow $100,000, $1 million, $10 million out of their insurance policies at 5%, and they earned 16% or even 25% that year. I had one client borrowed out $1 million. They charged $50,000, but they credited his $1 million still in the insurance company. That's the collateral for the loan he got, $250,000. $250,000 minus 50, he netted 20% or 200 grand tax-free on his $1 million while he was using it, theoretically, okay? Even though he borrowed it, it's really the same $1 million. He made $200,000 on it while he was making money with the $1 million over in his business. Are you starting to get it? Let me tell you how you can even do better. Now, if you've already gotten some epiphanies, search my YouTube channel, 3 Dimensional Wealth, subscribe and share. And you'll see a lot of other similar educational videos that will help you understand this. And if you stay with me here for a few more minutes to the end, I'm going to empower you to claim your free copy of my most recent 300-page best-selling book called The Laser Fund. Okay? Let me share a story with you of not only real estate investors and business owners, but this was a very savvy man who understands how money works. And he lived in Hawaii. He didn't grow up there, but that's where he retired. And I remember meeting him after he came to one of my educational workshops. And I sat down and I knew immediately he knew how money works. In other words, he knows that banks, credit unions, insurance companies, they get money. It's in a lended position, public, okay? They invest money, they deposit it into banks, credit unions, insurance companies. And what do those institutions do? They turn around and make higher rates of return. See, a bank or credit union's greatest asset is its liabilities. If they stopped paying interest, they would wither up and die. So most people view interest as a foe. No, it's a friend. But see, there's a difference between good debt and bad debt. And I have other episodes that talk about this. But this gentleman, this is what he was doing. He realized that in Hawaii, there was this building construction boom. And there were a lot of contractors who were making money hand over fist, building homes and condos and everything else. But they needed working capital in order to build the homes, the spec homes and so forth. And sometimes the banks were hesitant and what have you. And so they would borrow from him, because they didn't have the credit or whatever, but he knew how to collateralize it with the property and the building. So what he was doing is he was borrowing from the banks at 4.5%, 6%. When he does it right, he can tax deduct it. So if he's borrowing at 6 tax deductible interest, it's a net cost of 4 in his tax bracket, 33%. So he's borrowing money. In fact, right now he's borrowing money as cheap as 3%. A net of 2%. So he was borrowing money from the bank that the contractors did not have the borrowing clout. So let's say he borrows $1 million. He was actually borrowing tens of millions. Let's just say $1 million. He borrows $1 million at 3%. That's 30 grand. Now these contractors were churning buildings and properties and condos so fast, they were willing to pay 16 and 20% in order to borrow that money and have it on hand. So he borrowed the money out of the bank at 3. Now, while he's waiting to find contractors who want to borrow from him, where do you think he puts it? He turned around and put it in the Laser Fund, increased the safety of that money by 6 notches and the rate of return, and he was averaging at least 9%. How much more is 9 than 3? So on every $1 million he borrowed from the bank at 3, he was earning 9. He's making $90,000 tax-free interest. He's only paying the bank $30,000. So he's making 60 grand there. Then he turns around when he finds a contractor, he borrows out of the Laser Fund at 5, and he kept earning 10, 16, 25 on that money that he borrowed out of the Laser Fund, and he loans it to the contractor at 16, 20, 25%. If you looked at his spreadsheet, he's making money because he made 300% more than the cost of the money from the bank. When he borrows out of his Laser Fund, he's making sometimes 200-300% more than the cost that the insurance company is charging him. And he turns around and loans it to a contractor, and he's making money hand over fist. This guy was knocking down hundreds of thousands of dollars a month by simply using OPM. This wasn't his money. He was borrowing it from the bank, putting it into his insurance contract, taking it out of there, making money, and loaning it to contractors, and they were making money. Everybody's making money. Everybody's happy. But this is the velocity of money. This is what you can do. This is where you can invest your net profit from a business so that you become your own banker. Are you getting it? So if this has aroused curiosity and you want to learn how to do this yourself, set up your own laser bank, we actually have a video series on that very topic. But I would recommend you for sure claim your free copy of this book. It's my 11th book. It's been flying off the warehouse shelves. I'll pay for the book. You go to laserfund.com, Laser fund.com. Contribute a nominal amount towards the shipping and handling. I'll cover the rest of that expense. I'll pay for the book, fire it out to you. I want you to study this side. It has about 200 pages of charts, graphs, and explanations. I know if you learn more by stories and examples, you can just flip the book over. That's why I wrote it this way. This is 100 pages, 12 chapters with 62 actual stories on how the laser fund can work for all kinds of situations, but especially for your own personal bank. If you're a business owner or you don't even have a business, you can become your own banker. So I would encourage you study this, and there's also options there for additional training if you like to listen and learn and watch and learn. But here is to your brighter future.